Great. Thank you for the intro and good afternoon, or good morning rather, ladies and gentlemen. I've got to say I'm really happy to be up here. It's been over 2 years of Zoom webinars and it's really great to see people in real life. My name is Guy Anderson and I look after the Mercantile Investment Trust, which as mentioned has been around for north of 130 years now. And the focus of Mercantile is to deliver long-term capital growth by investing in a diversified portfolio of UK-listed mid and small caps. And that's really what I'm going to talk about today, why we think this is a really exciting part of the market, some of the great companies that we can find in the UK, and then why we think that's a really compelling part of the market in which to invest. I'll start off really by highlighting the case for mid and small caps, why we think they have the opportunity to deliver superior returns to larger companies over the long term. I'll then run through a little bit in terms of how Mercantile is managed specifically. It's very much a portfolio built on bottom-up stock selection. We think that's incredibly important. And then I'll spend a couple of minutes talking about the outlook and the positioning, albeit I'm pretty sure that Jim is better qualified than I am to talk about the macro outlook. So in terms of the case for mid and small caps in the UK, I think the UK is actually a much maligned stock market. And what we show here is the returns over the last 25 years. And the orange line, which is towards the bottom, shows the returns that one would have generated by investing in the FTSE 100 25 years ago. And we can see that £100 invested in the FTSE 100 25 years ago, when reinvesting dividends, would be worth around £400 today. Now, in contrast to that, if the investment had been made in the FTSE 250, which is the mid-cap market, that £100 would be worth £1,000 today. So over 25 years, the power of compounding slightly superior returns year in and year out really does magnify to a tremendously different outcome. So to put those numbers in context, the FTSE 250 has delivered around 10% returns per annum versus the FTSE 100 around 5.5% per annum. So quite substantial outperformance, but clearly it's the compounding that leads to the much better outcomes. Indeed, the FTSE 250 has driven returns which are pretty similar to the S&P 500 over that time period. Now, if we overlay the returns from Mercantile, we can see the additional benefit that can be accrued by investing in an actively managed portfolio. And over the time period that we have here, the 25 years, the £100 invested in Mercantile would be worth around £1,800 today. So that additional return every year, in which Mercantile has returned just over 12% per annum versus that 10% or 9.8% for the FTSE 250, really does compound. Why is that? So first of all, I think everyone will intuitively agree that there are greater opportunities for smaller companies to deliver higher growth than larger companies. As companies grow, ultimately, their growth will be limited by the size of the markets in which they operate, whereas that's not necessarily the case for smaller businesses. I think it makes sense that smaller businesses are more nimble and in many ways can adapt to change. And I think WH Smith's is a really interesting example of that. This is a business that over the last 20 years or so has tilted away from being purely or predominantly a high street retailer to a business that is focused much more on travel retail. Now, whilst that's clearly been challenging over the last couple of years, there are far better long-term economics of operating in travel retail where you have a captive customer base. And I'm pretty sure everyone here will acknowledge that they have overpaid for a bottle of water or similar at a WH Smith in a travel location and not really thought twice about it. That is why they get superior economics. In addition, their high street business has continued to flourish despite the widely reported death of the high street, and that is because they have moved away from selling a whole load of products that no one buys any longer, so CDs, DVDs, videos, etc., to different product categories that are not as much at risk of disintermediation by the internet. So stationery is now one of their largest categories. So I think that nimbleness really feeds through into better growth. In addition, in this part of the market, there's a lot of exposure to companies that can innovate or disrupt existing businesses and potentially displace incumbents. And I think Softcat is a really good example of this. Softcat is a business that we invested in at its IPO, which was back in 2015, and it's now one of the largest holdings in the portfolio. This is a company that acts as a sales channel for IT vendors. So effectively, they will sell to corporates in the UK all the technology solutions on behalf of the Microsofts of this world. And as everyone knows, the adoption of technology is going in one direction, and they have been able to benefit from that, sufficiently so that they have now delivered, I think it's 65 consecutive quarters of year-on-year organic revenue growth. If we think about that, that is a tremendous track record. And I think the outlook there remains fantastic. And then thirdly, there are more opportunities for smaller businesses to grow dramatically because of their exposure to rapidly growing new markets. And Team 17 is an independent video games developer that we've invested in that, again, I think is a tremendous example of this. As I think many people will be aware, video gaming has increased in popularity over the last few decades, and that not only are there a greater number of people who are video gamers, as the children who grew up in the 80s and 90s are still gaming into their 40s, they're also dedicating a greater number of their leisure hours to this activity in favor of, for example, television. So hopefully that gives a little bit of an overview in terms of why we think there's greater growth potential, and ultimately that will drive superior returns. In terms of the Mercantile specifics, how we go about trying to exploit that opportunity, I'll just spend a few minutes going through this now. So Mercantile's primary goal is to deliver long-term capital growth by investing in what is a diversified portfolio of UK-listed mid and small caps. So we have around 75 investments in the portfolio, and the portfolio is built on a fairly rigorous bottom-up stock selection. So we care really deeply about the individual companies as opposed to spending too much of our time thinking about the broad macro. Of course, we're macro aware, but it's driven by the individual opportunities. I'm very lucky in that I look after the mid and small cap team at JP Morgan, so I have a good breadth of investors that help me and give us really good access to a whole number of some of these fantastic management teams that we can find in the UK. So on an average year, we will meet between 350 and 400 companies, and that's hugely important, particularly at this area of the market, where the strength of the management team can really determine the success or failure of the businesses. In terms of the portfolio characteristics, just worth mentioning, the portfolio is around £2.5 billion in size, which is relevant because it provides liquid access via the shares of Mercantile into what can be a relatively illiquid asset class. And then, of course, with that scale comes relatively low fees of 48 basis points, so just under 0.5%. Now, of course, that's only interesting if it translates into decent returns. We can see on the right-hand side the returns over the last 1, 3, and 5 years, and I don't think it'll be a surprise to anyone that it's very disappointing to show these numbers over the last 12 months. Yes, they're positive, but they're fairly anemic. And of course, the last 12 months have been pretty challenging, particularly, of course, over the last few weeks. But I would emphasize that this is a long-term investment vehicle. And if we consider the returns over the last decade, which ties in with when I came on board, we can see that, of course, they are not linear, and there are ups and downs, and there are periods of market shock. And if you look in the middle of the chart, you can see the period around the Brexit vote, so back in 2016, which was a fairly challenging time for the portfolio. And then further to the right, of course, we can see the impact of the pandemic, and then more recently, the impact of the Russian invasion of the Ukraine. But ultimately, notwithstanding those periods of increased volatility, the long-term returns have still been, I think, reasonably attractive at 11 or 12% per annum. Now, whilst capital growth is incredibly important, I think it's worth noting that Mercantile also pays a fairly robust dividend to investors. So with a running yield of around 3%, the important message here is that the dividend has grown over the last 30 years at about an 8% level per annum, so well in excess of inflation. And a lot of that is driven by the investment trust structure, which of course allows smoothing of income so that the income received by the end investors doesn't need to directly match the income into the portfolio. And last year was a good example of that, when, of course, there was a lot of impact to income into the portfolio as a result of the pandemic. But because we had strong reserves in place from prior year dividends, the board was still able to increase the dividend paid out to investors. In terms of how we go about building this portfolio of individual stocks, I thought I'd spend a couple of minutes explaining the investment philosophy and then maybe bring that to life with one or two examples. So I do believe that it's really important to have a rigorous investment process and a disciplined investment process. And discipline is probably the most important element of it all. So we have to be disciplined in choosing stocks for the portfolio, and then we have to be equally disciplined in removing stocks from the portfolio. So what is it that we're looking for? We're looking for companies that have strong business models and which operate in growing end markets, but crucially, which are managed by strong management teams who will reinvest capital and drive future growth. And as I mentioned, we spend a lot of time meeting companies to understand how they're positioned, and incredibly importantly, to talk to them about what they're hoping to achieve over the next 3, 4, 5 years, which is the typical holding period for an investment in the portfolio. On that point, we're thinking about the outlook over that time period and whether the business is going to grow and deliver better results than perhaps the market is currently expecting. And then, of course, thirdly, we have to think about the context of the valuation of those shares, because it's not just about the business and the business opportunity, it's how those shares are valued in the market. So that's fairly dry. So to bring it to life, a couple of examples. So the first is an investment in a company called Dunelm, which I'm sure many of you are familiar with. I'm sure many people here are customers of. This is a retailer which was set up originally as a market stall in Leicester just over 40 years ago. So Bill and Jean Adderley took on a market stall and they've built it into a business which today is worth around £2.5 billion over that 40 years. And it's grown from that small origin to now being the largest retailer of home furnishings in the whole of the UK. So quite a tremendous growth story, and I think a really good success story for UK business. What attracted us to this investment specifically, and this was a new investment into the portfolio at the beginning of 2019, was the changes that had happened in the 6 months before then, when a new management team were brought in, Nick Wilkinson and Laura Carr as the CEO and CFO respectively, and they put in place what is called their customer first strategy, which was really focused, and Nick has a great phrase here. He refers to it as operational grip. It was about improving the operational grip of the business, because retail is all about the detail. And he's focused on many little aspects of the business, improving the product offering, but crucially improving the route by which customers can buy products. And Nick is obsessed with delivering the perfect order. I think that's a great template for this business. And that is one of the reasons why the organic growth of this business has picked up and been so strong despite the tremendous disruption that was caused by the pandemic. And we have huge confidence that this business is going to continue to deliver market-beating returns, such as it has over the last few years. And all of that comes at a compelling valuation with a very high cash generation. A more recent investment in the portfolio, but actually a much older company, is our investment in IMI, which is a business that has been around since the 1860s, was in fact part of ICI around 50 or 60 years ago until it was spun out as a separately listed entity. And this is a business which is a high-quality engineering business, which has built up in the UK over the last 150 years to focus on a number of different flow control technologies. So what that means is any industry that requires the transport of fluids will use a number of different valves, actuators, pumps, etc. And IMI specializes specifically in the valves, but also in the related technologies. And this is a business that, as I said, there is a lot of intellectual property here, but which over the years has struggled to deliver particularly exciting revenue growth. And I remember visiting one of their sites down in the west of England about 2 or 3 years ago. 3 years ago it was, before the pandemic. And there had been this huge focus on lean manufacturing techniques to improve the efficiency of their operations. But at its heart, it was still a very inward-looking engineer. And I can say that, having been an engineer myself, that is often a criticism that can be applied towards the industry. Now, the new CEO, Roy Twite, who is himself an IMI lifer, so he's been at IMI since the 1980s, moved into the CEO role a couple of years ago and has really increased their commercialization focus. So what does that mean? That means working much closer with customers in order to understand their problems and then develop solutions for those problems, which ultimately translates into improved revenue. And I think it's fair to say that where we sit today, where it's very difficult to envisage investment into oil and gas not increasing, this business has a pretty rosy future. So hopefully that gives a little bit of color on the kinds of companies in which this portfolio is invested and some of the reasons why we make our investments. Now, I'm going to move on to spend a few minutes talking about the outlook and the positioning, but I'm very conscious that my comments on the macroeconomic environment will be somewhat limited because the focus for us is very much on the bottom-up stock-picking opportunities that we see. So I'll talk about the macro as we see it in terms of the key points of relevance. And for us, first and foremost, whilst we're investing in companies which are listed in the UK, they have an international presence. And when we look through the portfolio, roughly 50% of the revenue of the portfolio is delivered domestically and roughly 50% is internationally. Now, in terms of the domestic exposure of the portfolio, roughly 40% of the portfolio's exposure is to the UK consumer. So that is incredibly important. So of course, we have to have a view on domestic consumption. Now, over the last couple of decades, the two biggest drivers of consumption have been the strength of the labour market in the UK and the strength of the housing market. And the charts here just show each of those in turn. And actually, both of those are incredibly robust at the moment. The labour market, as we saw from the stats just this week, continues to be very high, very low unemployment, and a huge number of vacancies. So actually, I think we can take quite a lot of comfort from that. The housing market as well, I'm sure everyone is aware, has continued to go from strength to strength. So usually, those would be two pretty positive indicators that would give us a positive disposition towards the domestic consumer. But unfortunately, it's not quite as simple as that. Inflation, as everyone knows, has been rising quite dramatically over the last 12 months or so. And the chart on the left-hand side just shows the inflation levels in the UK. And we can see here, the data just goes back over the last 5 years or so, and we can see how inflation has picked up from very low levels back in 2020 and 2021 and has now reached sort of mid-single digits and quite frankly is going to be increasing over the coming months. The dotted line just show the official forecast as opposed to our personal view, just to be clear. So we're in an inflationary environment, which means we're in an environment where real wages are going to be negative. In other words, as everyone will have read, there is this impending squeeze on consumption, and that has fed through to the chart on the right-hand side, which you can see is declining consumer confidence. And that is, of course, a bit of a worrying sign for us, and that is something that we have to think about quite closely. And that is a change versus 12 months ago, where the outlook for domestic consumption, particularly as we exited the pandemic with this fabled 200 billion in excess savings that was going to be deployed, the reality is it's going to be a little bit tougher, certainly in the near term. What that means for the portfolio is we have to think incredibly carefully about the individual stocks in which we're investing. And then I'll bring you back to the Dunelm example. Dunelm has grown their sales at 10% per annum over the last 5 years. 85% of that growth has been market share gains. So it has not been required, it hasn't been dependent upon a growing end market. And those are the sorts of companies that we want to target in this environment, where there are clear uncertainties about the outlook for consumption. When we think about the international exposure in the portfolio, the industrial sector is hugely important. Industrials in aggregate make up around 30% of the portfolio, and much of that exposure is international in its nature. And again, this is a slightly frustrating area for us, where demand has been incredibly robust as we've exited the pandemic. And on the left-hand side of the chart, we show the PMI data. So this is a lead indicator for activity in the industrial sector. And the axis, which is the 50 line, is effectively if it's north of 50, it's expansionary. If it's south of 50, we're in contraction. And we can see that both the new orders and the future output figure recovered incredibly strongly as we came out of the pandemic. But then we've experienced over the last 12 months huge disruption to supply chains, and that has constrained the recovery. The outlook is still positive, but it is constrained. There have been a number of constraints in supply chains, and of course, I'm sure everyone is familiar with the semiconductor shortage, which feeds through into a large number of industries, in particular, for instance, the automotive industry. But of course, freight rates, so the cost of transporting goods from, for example, China to Europe, etc., have been very elevated and have added costs into the system. And now, of course, many companies will have to deal with the increasing oil price, which was already increasing prior to Russia's invasion of the Ukraine, but which adds a further headache. So again, in this environment, it becomes important that we think about the precise exposures of the businesses. So whilst the outlook for automotive production may be declining, I think, as I said before, the outlook in the oil and gas space is looking rather more favorable. So we have to think quite carefully about the specific stocks and where their exposures are. Now, whilst some of that macro might sound a little bit on the gloomy side, I do think it's important to think about the valuations, as the context is really important. And the chart here just shows UK equity valuations relative to MSCI World, so relative to the rest of the developed markets. And we can see that over the last decade, the UK has gradually become a cheaper and cheaper market relative to international markets, and today is trading at around a 40% discount to the broader markets, versus its average over this period of the last 50 years of about a 20% discount. So it always trades at a bit of a discount, reflecting its sector mix. It's quite commodities focused, quite financials focused. That discount is quite elevated. Now, if we think about what the valuation is on a forward-looking basis, just on a simple price-to-earnings ratio, the UK market is trading at around 11 or 12 times. So in other words, the valuation is 11 or 12 times the expected earnings over the next 12 months, which gives us a certain amount of reassurance. Of course, there's a big canary here, there's a big elephant in this room, which is what's happening with Russia and the quite frankly tragic events that we're seeing unfold there. And we'll have to keep a very close eye on that and how that develops. But at the moment, the valuations are at relatively depressed levels. So when we build the portfolio, as I've said, it's a combination of the individual opportunities that we see in stocks, and then, of course, we have to overlay that with the top-down view that we have formed at any one point in time. But hopefully that will come across here, where we're just listing the 10 largest investments in the portfolio. So in many ways, it may or may not be interesting to hear what people say, but the most important thing is what they actually do. And clearly, the 10 largest positions here are those in which we have the greatest confidence or the greatest conviction that we can see the strong return profile ahead. And as a portfolio that is built on bottom-up stock selection, you can see that those companies come from a range of different industry sectors. So technology features quite heavily. Technology makes up about 10% of the portfolio. Softcat, which I mentioned before, the IT reseller, is our largest holding in that space. But then Computer Center is another important holding. That's a company that has, in fact, just last week, delivered some fantastic results, and they continue to see very strong outlook. Again, a range of different companies. So whilst technology features, we've also got a house builder in the top 10, Bellway, which is valued at roughly in line with its asset value, despite the fact that it's generating really quite fantastic returns, and despite the fact that the housing market is going from strength to strength. And then companies from a number of other sectors, whether it be a couple of distributors, such as Inchcape or Electro Components, or a retailer, Dunelm, and indeed another retailer, Watches of Switzerland, which is our largest position in the portfolio and which has really demonstrated its resilience over the last couple of years. So I'll just spend 1 minute on Watches of Switzerland because it is our largest investment. It is approximately 5% of the portfolio. This is a retailer of luxury watches, so Rolex, Audemars, etc. And they effectively are the distribution channel for the luxury watch manufacturers in the UK, in a number of markets in Europe, and in North America. So Watches of Switzerland sell approximately 50% of all Rolexes sold in the UK, to put a sort of context on it. And the really interesting thing about the luxury watch market, which I hadn't appreciated prior to investing into this business, was that demand massively exceeds the level of supply. So these are supply-constrained products, which means that even through, for instance, the pandemic, when all of the stores were closed and 30% of your potential customers in the form of tourists were no longer coming into this country, their sales didn't miss a beat. They just carried on growing. And I think that's a good demonstration of the strength of the business. And this is a business that has gone from just operating in the UK to now having a burgeoning business in North America and a nascent business in continental Europe, and one which we expect to continue to go from strength to strength. So just to summarize, first and foremost, I hope I've brought to life some of the really exciting companies that we can invest in the UK. I think the UK is blessed by having a tremendous number of fantastic corporates. Of course, I'm biased. I do think the most interesting ones come in the mid and small cap end of the market, and I would really encourage people to consider this part of the market as being a very attractive space in which to invest. And hopefully I've emphasized the importance, or as I see it, the importance of active management in this part of the market, where we can try and pick the most compelling individual stocks, because that way we can drive strong returns over the long term. So with that, thank you very much for your attention.